already. So no issues anywhere. Good stuff. Thank you guys for showing up. This will be Mailbag Webinar episode 2. Just answering questions that you guys sent in. 4 questions, short and sweet, but good questions. And we've got some film to review at the end. And yeah, we'll go from there. This is being recorded, so you'll be able to watch it at your convenience. It'll be posted this weekend. I will ask if there's any questions throughout. If you do have a question, just post it in chat and I will make sure to cover it. So thank you guys. Let's get started. So first question I received was, why do I use a 3-minute chart as opposed to a 1-minute chart? For me, I find a 3-minute chart to be much more smooth than a 1-minute chart. I found in the past that a 1-minute chart gives me too many false signals. So the reason I use a 3-minute chart is I feel it is more indicative of a real trend versus a 1-minute chart. And the analogy I would use is when you're looking at a painting. If you stand super close to the painting, you might not see all of the details. Maybe you miss something in the corner, something on the other side. But if you stand further back, the painting becomes clearer. This is subjective though, and it's just my personal preference. I like a 3-minute more than a 1-minute. If you find greater comfort in using a 1-minute chart, then do your thing. Use that 1-minute chart. But here's an example of why I don't like a 1-minute chart compared to a 3-minute chart. So this is a 1-minute chart of Apple from today, which is November 18th. Apple from 12 o'clock to 3 p.m. Eastern. We can see this is a 1-minute chart where you had this move down, then this move up, this move down, this move up, this move down, and a lot of different movement, apparently, when you look at it like this. However, you look at the 3-minute chart, it's the same exact time frame, 12 p.m. to 3 p.m., and it's pretty clear that this is just a consolidation. You just stayed in a really tight range all afternoon. So the 3-minute chart helps keep me away from trying to figure out a directional trade in a tight 30 to 40 cent range. If I'm looking at this 1-minute chart, I'm standing close to the painting and I'm not seeing the fact that this is just a bigger consolidation. Alright, so if I'm only looking at the 1-minute, maybe I'm trying to trade this move down, maybe I'm trading this move up, down, etc. Which again, this is all subjective. Maybe you like this type of action and you're trying to catch every 20, 30 cent move. For me, I'm not trading a 20, 30 cent move on Apple. It's just not worth it enough for me. And that's where I really like the 3-minute chart, because it helps me look at this and say, okay, Apple's just in a tight 30 cent range, consolidating. I'm not going near this thing until it breaks out of this consolidation channel. The 3-minute helps me avoid what I think are false signals within the closer 1-minute chart. Also, just so you guys know, so you see the 3-minute chart on my screen because that's the screen I'm sharing every day with you during my live sessions. However, on my third screen that you guys don't see, I've got a combination of a 3-minute chart, a 15-minute chart, and a 60-minute chart, along with the daily chart. And so I like using these kind of all to confirm each other. I've got the daily at the top. This is a screen grab directly from my platform. This is what it looks like on my platform. I've got the daily at the top, 3-minute in the lower left, 15-minute in the middle bottom, and 60-minute in the lower right. So the question was, why do I use a 3-minute chart instead of a 1-minute chart? Well, technically I'm using 3-minute, 15-minute, 60-minute. I'm using all of these, so I don't want you guys to think that I'm only using a 3-minute chart. I like using these to kind of confirm each other, and I think that's important, that you want charts to confirm each other. If you see a signal or you see trends on the 3-minute chart, you want them showing up on the 15-minute chart. That'll give you greater confidence. If you're seeing something on the 60-minute that isn't yet showing up on the 15-minute or 3-minute, maybe you're a little bit concerned and you kind of use that as a signal for a hedge trade or something of the sort. Bottom line, I think you should use charts to confirm each other. Don't rely on just any one single chart. Next question. This person noticed that I'm often placing my bids below the current bid price on an option, and they want to know why I do that, and if I don't fill on that bid, would I raise my bid? So for me, once I deem a trade setup to be favorable, it's always natural to kind of rush and buy instantly, and that's just a natural feeling I get. You guys maybe get it too. And when I get that feeling, I stop and I think, and I ask myself, do I need to chase this move? That's what I always ask myself before rushing to buy in. Do I need to chase this move? Do I have to get in right here, right now? 9 times out of 10, the answer is no. I don't need to chase. So instead, if I see a bid-ask spread of, say, $2.50 on the bid and $2.70 on the ask, you'll notice a lot of times I'll try putting my bid in at $2.25 or at $2. I'll place it 15-20% below the bid, 10% sometimes. And the question is, what if I don't get filled? Well, that's why I always attach a time frame to it. During my live sessions, you'll always hear me saying stuff like, I want this bid to fill within the next 5 minutes. How many times have you heard me say that? I say it a lot. And those time frames are important because if I haven't filled within that time frame, then I can start making adjustments and considering raising my bid or even hitting the ask. But first, what I like to do is place it below the bid. And obviously the risk is that I won't fill and I'll be left out of a good trade, but that's a risk I'm comfortable with. Personally, I would rather miss out on a winning trade and wish I was in that trade than participate in a losing trade and wish I was out of that trade. Now, there's a few different benefits to trying to enter this way, and the real reason I do it. Number one is that the majority of stocks with liquid weekly options, except for Apple, but I'm talking Tesla, Netflix, Google, Amazon, the stocks you guys always see me trading, and then of course other popular stocks like Priceline and LinkedIn, Baidu, stuff like that. Generally, these can have anywhere from 3% to 15% in between the spread, sometimes even 20% in the case of Google and Priceline sometimes. So if you think about that, and I buy at the ask on a spread that's 10%, and then I'm forced to sell into the bid, now I'm already down by 5 or 10%, possibly more. And that's assuming the bid-ask spread hasn't dropped another 10% by the time I go to sell. Take this example up here, for instance. If I buy in at 270, and 250 by 270, we'll see that spread all day long on just about every single stock I trade, except for Apple. Apple has a much tighter spread, which is nice. But so right there, that's a 7% spread. So if I hit the ask at 270, and then for whatever reason I say, you know what, I got to get out, I need to exit right away. Well, the only way to exit right away and guarantee you exit right away is sell into the bid. So now I'm exiting at $2.50. Right away, I have a 7% loss, no matter what. And that's assuming the bid and the ask spread hasn't dropped another 10% by the time I go to sell. Maybe this bid-ask spread is 250 by 270. A couple minutes go by and it starts to go against me. I get nervous, whatever, and I decide, you know what, I need to exit. Well, now the spread has gone from 250 to 270, 250 by 270 to 230 by 250. And not only has the bid dropped, but now the ask has dropped 7%. And again, if I'm selling into the bid and I'm selling at 230 from that 270 entry, now I'm losing 15%. And, it's like nothing even happened. I got in at the ask and now I'm forced to sell into the bid. So that's the main reason I try and buy below the bid, is that in the event I need to get out and I have to sell into the bid, I'll already be playing from behind if I'm constantly buying at the ask. The other reason I like buying on the bid is because now the spread can work for me instead of against me. Okay? You take this same example again, 250 by 270, and let's turn it around. Instead of buying on the ask at 270 and being forced to sell into the bid, say I got filled on the bid with my entry, I'm in at 250. Now, if I'm able to sell on the ask right away, now I have a 7% gain instantly instead of a 7% loss instantly. So you just kind of turn it around on its head. Furthermore, if I have to sell out right away and I was able to fill on the bid, now I'm exiting on the bid at break even. So instead of the spread working against me, it's working for me. Another positive of this is I can give my trade more of a chance. If I can fill below the bid 10 to 20% lower than I usually would, where I'd probably be stopping out really, now I'm more likely to stay closer to my break-even price at the beginning of the trade. And I'm always much more comfortable giving my trade a chance to work out as it hovers around break-even after a few minutes versus being down 10% right away. So, say I get this fill at $2.25 and then the spread stays around 225 by 240 for, a few minutes. I'm going to be much more comfortable having filled at 225 knowing I'm still right around break even versus filling at 250 or 270. You go down to 225 and now I'm sweating bullets because I'm down 10% and I don't want to lose more than 15% on the trade, so I'm already thinking about stopping out. Well, this way I'm around break even, so instead of stopping out, now I'm entering where I would be stopping out. That's the other thing about this. Instead of stopping out 10 to 15% below where the current ask is, now if I can get in 10 to 15% lower, I'm essentially entering at my stop loss area. It makes the trade much easier to stay comfortable in. Another benefit I found to this strategy is I find myself making less trades due to the inevitable occurrences where my bid doesn't fill. It happens a lot. I'll place a low ball bid. That's the expression I like to use, low ball bids, and they don't fill. And that's fine. I just don't end up making the trade. And in my experience, what I find is that my win rate is higher in these situations. When I force myself to only get in at very low prices and maybe it fills, maybe it doesn't, my win rate is higher because I'm getting such high quality entry points versus low quality entry points filling at the ask and kind of being at the mercy of the market. And when I talk to other traders who have more experience than me and some who have less experience than me, they notice the same thing. The less we trade, the better we tend to do. Our win rate tends to go up the less we trade. If you think about a free throw shooter or a quarterback, the more passes a quarterback throws, the greater percentage for error. The quarterbacks that have super high completion rates are generally very efficient. They have a lower amount of passes thrown. Free throw shooters, you got a guy like Kyle Korver who has one of the highest free throw percentages in the league history. He never shoots a lot of free throws. All right, so the less trades you make, in general, what you'll find, in my opinion, as I don't have the actual numbers to back this up, I can only go off of my side, my numbers, and from speaking with people. So my opinion, though, is that the less trades you make, the more you will win. And I would imagine if you did find the numbers and have the exact data to support it, and trust me, I did look, you would find the same thing. And that's a great point, BK. Like you said, quarterbacks who throw less have fewer interceptions. In our case, fewer bad entries. Excellent analogy. Exact same thing. Thanks for adding that. Third question. Well, first of all, any questions on what we've covered here with these first two in terms of 1 minute and 3 minute and why I place bids, why I try to get in below the current bid? Okay. Next question. How do you pick which option strikes you will trade? Well, first of all, before I dive into this, what I'd want you to do, what I ask you to do, is go to the Introductions for New Members category in the video archive. All right, if you log into the site, you can see it right now. You just click the video archive, click Categories, and click Introductions for New Members, and you'll see this Why I Trade the Option Strikes I Do video. So please watch that, and that'll give you some insight. Again, that is the video archive, Introductions for New Members category, Why I Trade the Option Strikes I Do. It's in the middle of the page. but we'll dive into it a little bit right here. And BK, I see your question. I'll circle back to it after this. So there's three main criteria for deciding which option strike I want to trade. Number one, the time frame of the trade. That's the first criteria. If it's a quick trade, which for me a quick trade is 5 to 10 minutes, I want to be in the money or near the money because I want the premium to move well in reaction to the stock. And the closer you are to the money, the more sensitive the premium is going to be. If it's a longer trade, which 10 minutes to 60 minutes is a long trade for me, I am more likely to go out of the money to give the stock a chance to make the move I think it can make. And this is an example of kind of an anticipatory trade versus a reactionary trade. If I'm anticipating a bigger move, I'll likely go further out of the money because I'm anticipating the stock will get close to my strike over time. If I'm reacting to a move right away though, then it's more likely I'm going to be closer to the money. The other criteria is the day of the week. The day of the week plays a huge role in this, deciding which option strike to trade. Number one mistake I see people making when it comes to the option strike selection. They think they can trade the same strikes every single day of the week. Does not work like that. You need to be making adjustments. Every day is different. Option prices move way differently on Monday than they do on a Friday. So if it's early in the week when there's a lot of premium, Monday and Tuesday, I might not even mess with options. I'll just trade shares because I don't want to deal with the excessive premium on a Monday or Tuesday. If it's later in the week, Thursday, Friday, Wednesday, then I'll typically go near the money because there's a lot less premium on the option by that time of week. And I'll show an example here shortly. The third criteria is implied volatility. When implied volatility is high, premium is higher and option strikes are thus more expensive. I am more likely to be a seller of far out of the money options when there is a lot of premium on them. When implied volatility is low, premium is lower and option strikes are thus inexpensive. And I'm more likely to be a buyer of premium when there is low implied volatility. Yes, this document will be shared. I will be able to send it to you, so you'll have it for your review along with the video. All right, but so I want to go into some examples of these different trades here based on the day of the week. So this first example is going to be from Thursday, November 12th, last week. And this is going to be a trade on Tesla that I make. Alright, so just setting this up a little bit. Tesla had made an initial drop out of the gate. You can see it gapped down on this day around 218 and was going lower. So I liked a short trade on Tesla versus the 217-ish area, kind of right around where it opened, 217, high 216s or so. And what I'm going to do here is I'm going to trade a strike that is in the money. And that's because it's Thursday, there's very little premium, implied volatility was pretty low in this instance. So I'm going to trade the 217.50 strike put on Tesla. And because it's early in the day and I'm only looking for a quick trade, I want to be in the money. I want to trade a strike that's really going to react well to the stock price movement. So I circled around. Okay, so we're back looking at Tesla. So you can see now I'm getting ready. I pull up the 217.50 strike put on Tesla. And I just want to set this up for a second further. So again, I'm going in the money on this because I want the premium to react well to the stock price. What I'm looking for here is I'm looking for Tesla to come down right here, right now. I'm looking for a break below 215, and I want to sell that break to a new low. So I don't want to be very far out of the money because I'm not looking for the stock to go down towards 210. I'm just looking to get in and out quickly. And the strikes that you want to trade if you're going to be getting in and out quickly are the strikes that are in the money, or at least at the money. So I'm looking at this 217.50 strike put, 315 by 350. And you can see I'm getting an order ready with my limit price here. And let's just watch it play out. So it's trying to come back above 216. Once I notice that it's struggling to really move back above 216, that's when I make the entry. So still watching, not seeing any bidders coming above 216. And again, I'm just looking for a little move down to a new low. It looks like I was looking at Google for a bounce as well here, but back to Tesla. So Tesla's got some bidders at 216, and if it's whacking these out though, I'm going to jump in that put. And why am I doing this strike put? Again, because it's at the money. It's going to move if Tesla does drop. If Tesla only drops $1, this option is still going to move 15-20%. So right there, it tries to get a flash above 216. But it whacks them out. So this is where I'm starting to think, okay, this thing is about to make this move down. It's struggling to get back up towards that 217 area. I still don't have a bid in yet, but finger is on the trigger. You can see my cursor is over the buy to open. And so right here, this is a good example of what we just talked about, trying to get filled on the bid or below bid. So we've got a 325 by 350 spread, and I just placed a bid at $3.25. Why did I place a bid? Well, we whacked out 216, so we're starting to get ask stacking below 216. But again, I don't want to hit the ask right away here. I want to see if I can fill on the bid because I've got a 7% spread. So I want to try and fill on the bid. But it's going to be a quick trade, and once I don't fill on the bid, I start upticking my limit price, prepared to hit the ask, because I do think that the stock is going to be able to make a quick move down. But notice my bid here is at 325, getting a limit price set at 345, and if I feel like it's about to start breaking lower, I'll just hit the ask. Nice stacking, more down ticks. All right, so I did hit the ask right here. So again, I feel like it's getting ready to come down right here, right now. So I make an adjustment. Even so, still not getting a great entry, but not so much about the entry for this video. It's more, why am I trading this strike? This strike is in the money, and if Tesla goes below 215, I'll be able to sell this for a quick 40-50 cent gain. So I'm in at $3.50. You can see the position highlighted here. One contract, $3.50 average, and just want to let this play out. I'm gonna fast forward just a moment. And so as you can see, Tesla did break to a new low. All right, it went 214.79. Notice though, we only dropped $1. I just bought the put, and the stock was at 215.79, right? You look at it, it's 215.50 at 942.30. 942.30, it's at 215.50, and just a few seconds later, when we're below 214, 943.47. So 57 seconds later, my option is 405 by 420. And I'm on the ask at 425. So that's a good example of the at the money option being very sensitive to this drop in Tesla. It didn't take much at all, and I end up locking in profits right here into this drop that I was looking for, and that's it. Just a quick scalp trade on Tesla. Able to get a nice move from that option strike. So that would be an example of the quick trade where I want to be near the money, and also day of the week, that was a Thursday. So later in the week when there's much less premium and implied volatility was low. So I'm fine with just buying the premium. All right, next example is going to be a Monday, November 16th on Amazon. And now we're early in the week. And this is an example where I'm not even going to mess with an option. All right, so we're right ahead of the bell here. It's 9:29:36 in this video, and it's Monday. This is just this past Monday, and I don't want to mess with options. I generally don't like trading options on Mondays because of the premiums, unless I'm a seller of them. So instead of doing that, I'm just going to trade the stock instead. Amazon is gapping down a little bit, and basically I just think it can bounce. So we make a quick move down 639s, and I want to wash out kind of towards 636-ish, 635, and try and get a bounce versus that round level. Again, I'm trading stock in this situation. I really like the speed. Look how fast it's moving here. Washing out beautifully. But look at how the spread out. And now I'm bidding 637. You can see my order, 637 for 7 shares, small size. All right, but I want to rewind that just a minute to show how quickly it's spread out and why I placed that bid at 637. So what I want you to pay attention to here is when we come down to 637, the asks are very heavy initially, meaning we've got a lot of ask pressure. We have ask stacking where you've got a lot of asks in the 637, 638 range, but then there's a split second where the asks go up to 639. And once I see that, that tells me the sell pressure is letting up a little bit, and that gives me my signal to try it. So right here, so look right here, guys. Look at this ask pressure, 637.34s, a quick hard 3-point drop right off the open. I have no bid in at this point. I paused it to show how many asks we have. I'm going to click play again, and I want you to pay attention to when the asks spread out. 637 ask stacking still. Look at that now. Now look where our asks are. It took all those asks out, and now the asks are back up at 639. That's my first sign that there's a bounce here, that there is some let up in supply, and at that exact moment I placed my bid for 7 shares at 637 on the stock. And again, I'm trading the stock. I don't want to mess with the option, just not really my cup of tea on a Monday morning in this situation. But the order gets filled. Should fill in a second when it undercuts 637 again. And once the order fills, it does end up giving me a bounce, but we're going to come back to this video in a few minutes with another example, or another question rather, so I don't want to spoil all the goods. All right, now our next example and last example, day of the week, time frame for the trade, coming back to that, it's going to be from today, where I traded Tesla, and I traded calls on Tesla, but I traded out of the money calls. And the reason I trade out of the money is because I was looking to catch more of a greater move. I was kind of anticipating there would be a bigger move on Tesla. And I was, let's pull it up here. I'll just show you. I was trading the Tesla 220 strike calls. So as soon as Tesla, let me pause it to set this up. So what I'm looking at right here is Tesla is testing the highs. The high is 216, and 216 was significant to me because it was yesterday's high. It was our high for the week. So in my eyes, coming into today, and I said this pre-market, if Tesla could get above 216 today, I was going to be targeting 218 to 220. So once I see this action happening around 216, I'm starting to think, okay, my play is happening. It's playing out, and I think that 220 target is in play. So because I want to catch a fuller move, I'm going to try and catch 2 to 3 points here. I want to play out of the money because I want to give the stock a chance to get to my target. So in this case, I select an out of the money strike, but an out of the money strike that is in line with my stock target that I think could go in the money. The 220 is out of the money currently, but if Tesla ends up going to 220, these are going to be in the money and these are going to move very nicely. But since it's a longer time frame trade, more of that 30 to 60 minute time frame, I'm willing to go out of the money and give it more of a chance to play out. I'm not looking for the immediate term home run, so to say. So once it pops above 216, you'll see that I start to take a position. So right here, so it pops above 216 at 10:05, 10:06, and you can see that I've got a $1.48 average on these 220 strike calls. I bought the 220 strike calls at $1.48. All right, and the time here is 10:06. Now I'm going to fast forward because this ends up playing out. Now look at where we're at. All right, now it is 10:43, so what, 35 minutes later, and the stock is at 218, and look at my 220 strike calls now. They're up to $2.10. I'm getting ready to place my sell order as I'm starting to approach that 220 target. 218 to 220 was the target. So getting close to 220, already hit the bottom end. And I'm placing a sell order now at $2.18. And my sell order goes through at $2.18. You can see the closed P&L was able to make $124. And off of only a 35-minute hold. So from 148 up to 218, we're talking about a 50% gain, just about 47% to be exact. I'm just going to call it 50%. And again, though, traded out of the money because we're later in the week, not a ton of premium at this point. Implied volatility is low, so I'm willing to buy premium. And my time frame was more to kind of catch a fuller move. I was anticipating a bigger move. So in that case, I was fine with going out of the money and kind of making a bigger bet, so to say. Great question on that particular trade. That's a perfect lead-in to your question that you submitted, actually, BK. So I'll just talk about it now. And so our final question here is, what is my time frame for different times of the day? For instance, when you enter an aggressive trade the first 15 minutes, it seems it requires an exit within about 30 minutes. Can I shed some light on this whole topic of, when to enter, how do you choose how long you stay in, and all that stuff? And what you just mentioned in chat, I will cover on the back half of this answer. So first of all, if I enter a trade within the first 5 to 15 minutes of the day, then I'm typically looking to exit within the next 5 to 15 minutes of the day. That is generally my goal. That's what I'm most comfortable with, so that's what I do more times than not. And I want to go back to this Amazon trade that I entered on Monday. All right, so we're going back here to Amazon. Look at the time. It's 9:30:47. We are literally not even 60 seconds into the trading day, and I've got a bid in here to buy shares at 6:37. This is a very, very aggressive trade. So as soon as it fills, as I click play, we're going to see it fill in a couple seconds here when it swoops back below 37. All right, so the order has filled. You can see it's highlighted, position 637, 7 shares. And this is at 9:31 exactly that the order fills. 1 minute into the day. Very aggressive trade. an aggressive trade, I'm going to look to make an aggressive exit. I'm not going to wait around and see what happens. I'm just looking for a bounce right here, right now. So what do? I immediately place a sell order at 640. You see me put my limit price at 640, and then if we go forward just a couple seconds, stock starts to bounce, comes back down, it's washing around 637. Notice I've got my limit now. My sell order isn't at 640, but I've got my cursor over the sell button in case I need to stop out and take a loss. Prepared to take a loss since this is an aggressive trade. The spread is now 636 by 37. You can see my cursor is right over the close button to just get me out if I have to. But again, it's able to take out these 37s and ends up curling back up. Still though, look at our time, guys. It's only 9:32. Only 9:32. Only 60, 70 seconds have gone by since I entered the trade. Aggressive entry. I'm ready to be aggressive with my exit. Now I've started to bounce. Finger is still over that close button in case I need to close it off. When I enter aggressively like this, I'm always prepared to stop out right away. I'm not making an aggressive trade so that I can, stick around for a while. I'm making an aggressive trade so that I can get out right away with a quick profit. So continuing to bounce here. And you can see my sell order here is on the level 2 at 640 for 7 shares. And again, it's very important when I make this aggressive entry, I'm immediately placing my sell order. That eliminates the guesswork. It eliminates the chance to hesitate. If it crosses above 640, I'm going to get filled. There's not going to be any guessing involved. The order is just going to go through, and that'll be it. Aggressive entry, quick exit. Caught a 3-point bounce, that's fine. That's what I'm comfortable with. That's what I was going for. Alright, so the stock does end up getting above 640 for me. I believe on this push, it only takes, I entered at 931, it's 934. I believe it fills within the next 30 seconds or so. Crosses above 640. Right here I'm watching, is it going to come back into the 37s or is it able to come back up towards 39? Because if it's coming back towards 37s, maybe I need to just exit. But look at that, takes the asks out, right back up towards my sell order at 640, closer and closer. And there you go, crosses above 640, I get filled and catch 20 bucks. Even with 7 shares, still able to make 20 bucks, which, probably just peanuts to most people. But for me, I'm happy with the trade. I'm happy with the execution. In right at the open, off that level 2 washout, caught a 3-point bounce. That's solid stuff. Another example of an aggressive trade where I'm looking to exit right away came yesterday on Netflix, where the stock had gapped up. This is yesterday, November 17th, Tuesday, if my video will work here. Alright, so first of all, what was the setup that had me entering Amazon at 637? Number one, the stock had sold off heavily into Friday, and I was looking for a bounce. Monday morning, pre-market, I had just kind of was looking for bounces. It was really that simple. Monday morning, felt like, you know, we'd get some bounces across the board. So when it sold off really hard, I was just trying to time the bottom. And again, going back to when the asks spread out. All right, so rewinding here some. Remember when I showed you all that ask pressure? I'll show you again. So watch this. This is right at the open on Amazon. Look at all of our ask pressure. We're flushing out, coming down very, very fast. Look at this stack right here, 637.75s. I don't have any bids in because maybe it keeps coming lower. But again, I'm still looking for a bounce. That's just my bias. My bias is for a bounce on this particular day at some point. So if I see evidence of that bounce starting, or of supply slowing down, of the sell pressure slowing down, I want to look at it. So what I'm going to see is I see all this ask stacking into 637s, and then when I click play again, you're going to see the asks kind of scatter away. Ask pressure 637s, 37 ask pressure, boom. Look at our asks now, 39s. Just in a split second. Look at that. I'll replay it one more time. I'll pause it at the ask pressure with the stack. All right, here's our ask pressure into 637s at 930.20. 930.20, we have ask pressure into 637s. $930.27, 7 seconds later, those asks get taken out. So the way I interpret that is I say, all right, we had some sell pressure right there, but it just let off. And this is a strong stock. This is Amazon. It's been uptrending all year. It's been uptrending all month. I'm going to try the bounce. The question with regards, is it risky to place almost 5K on the line to make only 20 bucks? That's for you to decide. I placed 5K on the line, but I was never in a position to lose $5,000. It was a trade where I'm either going to make 20 or I'm going to lose 7. Because again, after I make it, once I get in this position, okay, look at where my cursor is. My cursor is over the close button. I'm right at break even. I am so ready to close this position the second it starts going against me. I'm not going to lose more than 7 bucks. If it goes below 636, I'm out. So, yeah, technically I'm risking 5K. I'm putting in 5K, but I'm confident in my ability and my discipline to exit if it's not working. So, I'm going to get out right away. All right? So, in my eyes, I'm risking 7 to 10 bucks in order to make 20 bucks. So that's a 2-for-1 risk to reward ratio. That's a good setup. What would be riskier is if I was trading an option, because now, you know, I'm putting in 500 bucks on a Monday to near the money option maybe, and if it goes down 10%, now I'm losing 50 bucks on that option. So for me, I actually think it was way less risky to trade shares in this case. Does that make sense? And BK, does it make sense as to the way the asks spread out? The setup for me was I was looking for a bounce, and once I saw those asks kind of scurry away, that's when I felt the pressure was letting up. It was ready to bounce. Yes, so as soon as the asks spread out, I placed that bid at 637. And it's okay if I want it to come back down because I want it to fill me, you know, so it does fill me, and we end up coming back to 637. But once I saw those asks spread out, it kind of gives me a line in the sand. It can tell me, okay, sellers are at 637, but it was able to take those out. So as long as it can keep taking out the sellers at 637, we're fine. If it starts getting sellers into 636s, now I'm looking at sell pressure that I haven't seen yet. And now I need to just take my loss and get out. So like right now, I'm in the position at 637. We've got the ask stacking back into 37s, but notice how it's able to absorb this sell pressure here and again take the asks back out towards 38. Had these asks started stacking below 37, then it's a bit concerning, but that doesn't end up happening. Also, my bidders are coming back up in the high 36s. And boom, right there again, asks are able to spread back out. All right, I want to move on to some other footage here of another aggressive trade, this time on Netflix. So Netflix had gapped up. This is from yesterday. So what I'm looking at is the stock gapped up and was holding on to the gap very well. So I'm going to click play. Again, this is aggressive. It's 9:31 right at the open. And I like the way it's holding 112 in this case. So if you keep holding 112, I'm looking at upside towards 113. So I have an order ready to buy shares if it starts moving higher. Again, what I'm liking, just to set this up, is coming into the day, we'd been on an uptrend all day the previous day. You can see this really clear uptrend on Netflix. And then you gapped up. So the gap tells me that there's follow-through momentum. And now if we can hold the gap, well, I'm going to expect the trend of yesterday to show up again these first few moments of the day. So I'm looking at the gap and I'm looking at the ability to hold 112 as an indication that it's going to keep trying to go higher. Look at that right there. That right there is my buy signal. I need to rewind that. That right there is my buy signal. I'll let it play once on its own so you guys can take it in, and then I'll commentate on it. So we're back testing 112, and just watch. Boom, right there. Anybody with any observations on that before I say what I see? All right, guess you guys only care what I think, huh? Just kidding. So what I'm seeing here is, number one, we're defending 112, and similar to that Amazon situation I just showed you, the asks scurry higher. So it takes out these asks, goes right up towards the high. The high is 1250, and just look how quickly we come up to that high. It's like a lightning bolt comes in this thing and just sparks it. Right there. And look at that ask stacking. Look how aggressively now we're up near the high, and look at our asks. I want to rewind it again just a second. And pay attention to these 112 bids, how quickly they go from bidding 112s to bidding 112s 30s, and how deep the bids are. Defending 112. Here you go. Bid stacking, bid stacking, bid stacking, 1230s, 1240 test, high a day test. So as soon as I see that, now I place my bid, and I've got a live bid at 112.30 to buy 30 shares of Netflix here, because I see that momentum pick up on the level 2. I remember the trend from yesterday, and I'm just looking for upside towards 113. Just targeting a 70-cent continuation move here. So you can see my bid is in at 1230. Hasn't filled yet. Alright, so my order has filled. You can see it highlighted, 30 shares at 12:30, and I'll just let this play out for the duration of the trade and commentate a little bit. It's actually going to come back to 112. And again, I'm going to get my finger over the close button in case I need to stop out, or it's already over the sell button right here. I place an ask at 113. That's the first step. Place my ask at 113, but then place my cursor over the close in case I need to stop out. So right here, it's going to back test 112, and I don't love that I'm seeing that, but check out the reaction that it makes off of 112 here. It actually undercuts it a little bit. Watch how quickly these bids come racing back up to my break-even line. Right there. Another perfect example of the asks spreading out and then the bids stacking up. We talked about that with the Amazon example. I rewound it to show it again. And I'm going to pause it when we have the ask pressure below 112. And I want you to pay attention to how the asks kind of scurry away. So at this point, I'm not really in love with that right there. Okay, check out our ask pressure below 112. And look, my finger is over the close button, because at this point I'm kind of thinking, all right, maybe I just have to get out of here with a small $10 loss on those 30 shares. Maybe it reversed, and maybe it's going to start trending down. So ask pressure below 112, but pay attention, because within 5 to 10 seconds, the asks are going to get scurried back up towards 1220, and the bids are going to start popping back above 112 pretty quickly. And that's going to be the signal that everything's okay, and she can start going up again. More ask pressure, sub 12. And then right there, takes them back out. Bid stacking back above 12, 12, 11 bids now. And it never tries to come back down to 112. It just gets going here, right back up towards the high. More stacking, 12, 16 now. Gets back above my entry, so now I'm feeling more confident again. And here we go. But again, an aggressive entry. So I'm on my toes, ready to exit, like I showed you when it was below 12. Had my finger over the trigger, ready to exit, because I don't want to guess. I don't want to wait around. I'm not entering this trade so I can wait around and see what happens all day. I'm entering this trade so I can see what happens over the next 10 to 15 minutes. Now we're testing highs, and just fast forward it a little bit to get to the point here. Stock did make new highs, continues to trend higher. My sell order is at 112.99, and it ends up giving me a spike above 113, and I end up getting filled. Any questions on that one? Those are two of the aggressive entries. Enter within the first 5 to 10 minutes of the day. I'm looking to exit within those next 5 to 10 minutes. Can I get more? Yeah, probably. But again, that's why I always am telling you guys, do your thing. Do what you want to do, because I'm going to do what I want to do. Alright, lastly, now we're going to talk about a trade where it's after the first 30 minutes of the day. So if I enter a trade after the first 30 minutes of the day, I'll generally have a longer time frame with the trade. And the reason is because by that time I have more information available about the stock's general behavior, and I can form an outlook with greater evidence. The first 2 minutes of the day, when I'm buying right away, it's typically solely based on level 2 action and tape speed, like I showed you in these previous examples, and it's more of a guess trade. And while I use level 2 and tape speed for signals, nothing can be confirmed within the first 5 minutes of the day, which is why I'm generally trying to exit very quickly if I get the move I'm looking for. So in this example, I'll take final questions at the end. In this example, this is back to the Tesla trade. So we touched on this a little bit, but I want to set it up further from a time frame perspective now. So stock is slightly below 216 at this point. It's 10:04, so 30 minutes into the day. 30 minutes into the day. So at this point, I've got evidence. I have more information available. And what I'm seeing from Tesla is that she keeps coming up to this 216 level. And my belief is that if she gets above 216, it's going to be able to make a solid move towards 215 to 220. And what I'd want to see if it crosses above 216 is I want to hold on to the 216 breakout. I don't want to come above 216 and then come right back down. So when I enter this trade here, which I do because we cross above 216 and it's at 10:05, I've got the 220 strike calls at $1.48 average. And it stays established over and around 216. The bids are able to stay up here in the high 215s. The asks are never able to get any pressure back below 216. So I'm willing to, have a longer time frame on this thing. Again, which for me is still a short time frame, probably for most people, of 20 to 60 minutes. Stock holding around 216, looks like it's kind of confirming the breakout. And I'm more comfortable with this trade and giving it longer time as opposed to the Amazon and Netflix trades we just covered, because I feel as though I have the information available and I know now what to expect, over the next hour. Amazon and Netflix right away in those two examples, I'm making trades instantly within the first 60 seconds of the day in the case of Amazon, where I can make a guess as to what's going to happen, but I just don't have a great idea. In this case, I have a pretty good idea that, hey, if Tesla stays above 216 here, she's going to go higher. She's going to go towards that 218 to 220. And you can see getting good extension, making new highs. So confirming the move, so to say, and just in general, doing a solid job. And then, when we go forward 40 minutes later, and you're up near this 218s, obviously it looks like it worked out, and you can see just this nice clean uptrend on Tesla. I don't want to go through every detail since it was a 40-minute trade, and that would take a lot of time to run through everything. But the bottom line is the level 2 stayed solid. It held the levels I needed to see it holding off of the breakout, and I was willing to give it longer time because I entered it later in the day when I felt like I had greater information available to give me more confidence in the trade. So some closing questions here. So one of the questions in relation to bidding, placing bids, was, do I enter a low bid and then scale in if I'm going for more contracts? Yeah, I'll do that. I did that last Friday on Amazon. I made a trade where I had like 3 contracts, where I had some really low bids and they all kept filling, and I was just like, okay, and it ended up working out. But I generally don't do too much scaling because I'm still trading relatively small. I would say on the surface, 1 contract, 2 contracts, typically never more than 3 contracts, unless it's something like Apple or a option that's priced under $1.50 or something, where 4 contracts is only going to be $500 or something, and it's still a small allocation relative to my portfolio. So kind of yes and no. I'll scale in if I feel like I'm getting excellent entries and it's a part of the plan, but I'm not going to get in. The worst habit that I used to have a couple years ago was averaging down on stuff, and that's just not something I like doing. Did I watch the rise on Tesla from 214 to 216 and delay the entry until above 216 in order to catch the rise towards 220. That is exactly what I did, and I even mentioned it during the session when it was around 215. We were talking about how Tesla looks okay, kind of looks like it's going to start making a move, and just trying to find it. Well, can't find it exactly where it was, but within the first 30 minutes of the day, I kept noticing Tesla holding 215, and I made a comment that if you want to guess on Tesla, so right here, it was right around 9:55, I started checking her out and saying, man, she's doing a good job holding 215, and I talked about how if you want to guess, if you like what it's doing, I think you could trade it long versus 215, but I would rather wait until it shows me the breakout above 216. So that's what I preferred to do, but obviously entering at 215 would have worked well. Entering at 214 would have worked even better. But yeah, you're right. I just kind of wanted to see it come above 216. I was willing to sacrifice a lower entry in exchange for greater certainty, greater confidence in the trade. What did the rest of the day look like? Would I have held for a longer run? In regards to the Netflix example is what I think you're talking about. The rest of the day on Netflix looked amazing, and shame on me because I did not end up getting back in, but there was numerous entry points to have gotten back in on Netflix, so that was my bad. Need to improve on that. But after I sold at 13 bucks, 113, it came back down to about 112.25ish, so I could have gotten back in lower, but the rest of the day looked beautiful. The rest of the day looked beautiful, and don't ask me what was up with me in that regard. Do I do any swing trades, and if so, what time frame do you use? I do some swing trades, but not many. If I do swing trades, it's typically just going to be buying the stock because I don't like holding on to options. I just don't really like it that much. Tesla topped out at, let's see here, 8:23. You must be talking Pacific time. So can I talk about exits and when to stay in a trade through a series of ladder steps? Well, first of all, when you should stay in a trade is, for your target. What's your plan with the trade, and go from there. That's first things first. Second of all, though, I covered this somewhat in the last webinar, so I'm not going to spend a ton of time on it. What I would rather do is refer you to the last webinar recording. But this is what I'd look at when trying to determine if you should stay in here. The 15-minute chart on Tesla. So this was an example that I showed in the recording last week on Tesla, when you just kind of stair step higher in the 15-minute chart, where you break out above the initial 15-minute high, and then that high acts as support, then you just keep breaking out. You get this kind of stair step, and then once the price finally fails to hold the previous 15-minute range and ends up going sideways the rest of the day. This was an example on Amazon from November 4th, and we saw really the exact same thing on Tesla today. So for people who are comfortable holding on, you can see this 15-minute chart. It failed to hold the previous 15-minute range right at about 11:30ish, the time frame you're mentioning. But notice every 15-minute candle prior to that, it was holding the previous 15-minute low, doing a good job staying in the range. As soon as it went below that previous 15-minute low, it started a little bit of a pullback and kind of went sideways the rest of the day. But again, for me, I sold on the way up towards 220. I sold at 220 just about. I think they ended up hitting like $3.50. So obviously I left a little bit on the table, but I was fine. 50%, it's a great trade for me. I'm happy with that. Obviously we all want to be able to make 100%, 200% as much as possible, but you got to do what makes you comfortable. And if you're comfortable and patient enough to hold, then I would look for these 15-minute stair step type patterns on the chart there. All right, I've got time for one more question if anybody has a final one here. All right, not seeing any other questions, so thank you guys for attending. This was recorded. Give me a little time though to get it posted. These are pretty large files, so and I don't. I do have a life. I am gonna shut down my computer after this and just kind of relax. And I probably won't get this posted until tomorrow night or Friday afternoon and have it. But I promise I'll have it for you by the weekend. Long story short, and I'll email it to you. And this document I will email to you as well for your review. And yeah, am I looking to apply any of these setups tomorrow morning? I'm always looking to do the best I can every single morning. And my favorite setups are when we wash out or kind of go straight up. I do think things are a little bit overbought into tomorrow, but Tesla, Netflix, Amazon, Google, they all had momentum today. So I'm just going to go into tomorrow with an open mind, see if we get some continuation, and I'll have a better answer for you 30 minutes before the bell tomorrow once I see what we're looking like pre-market. I try to avoid having big distinctions the night before, because then I think you can kind of get tunnel vision and only go into the day with one aspect. So I try to wait until I see what pre-market looks like before I start forming some of my biases. All right, guys, thank you for attending. I really appreciate it, and have a good night. I'll see you tomorrow morning. If you can, please get there by 9 a.m. Eastern. That's the best way to get the most out of the service, and let's do our best. Good luck. Thanks.